morning, everyone. I'm Eric Nova, principal of the Revision Group, broker owner of Nova Real Estate. I'm coming to you today from beautiful Naples, Florida. I am very excited for today's podcast as I have Michael Friedman and Stephen Stein joining me today. Michael and Stephen bring over 50 years of commercial real estate industry experience to today's show. Michael joins us today from Cleveland, Ohio, and Stephen from Los Angeles, California. We are here today to share with you the incredible and exciting news of Tauro Capital Advisors and the Revision Group's new joint venture. This joint venture has been put in place to solely benefit the many best-in-class sponsors both companies work with to advise on their full capital stack needs. Gentlemen, today's format is very simple. After I give the podium to Stephen to give us an introduction to Tauro Capital, I will do the same for Michael as well. Then I'm going to ask a series of questions to you both regarding debt and equity advisory for best-in-class sponsors. Stephen, since you are our guest today, I will give you the floor.
Well, thank you. Good morning, Eric, and good morning, Michael. It's great to be here and very excited, as you guys know, on our collaboration of Revision and Tauro Capital Advisors. So Tauro Capital Advisors, Scott Lee and I started in 2017. And as you mentioned, talking about best-in-class sponsors, we decided somewhat to create a best-in-class company using best practices that we've seen over our collective 60 years in the business. And of course, not every best practice means it's a best practice for what we're trying to accomplish, but we have a platform that we think is unparalleled in the industry. And then what was really exciting is when Revision reached out to me through LinkedIn. And that was about, I guess, a year and a half ago or 2 years ago. And we've created this collaboration to create even a more best-in-class collaboration of both debt and equity. So while Tauro Capital Advisors, we help our clients source debt and equity for all asset classes across the country. This collaboration, what we've done, as you guys know, is Tauro Capital Advisors will focus on sourcing the debt, and Revision will source the equity, but we'll also collaborate. So you guys may have some ideas on debt, and we may have some sources of equity. So at the end result, we're providing the best solution for our collective client. And that's who we are. Very excited to be here, Eric.
Thank you, Stephen. I appreciate that. Michael, can you tell us a little bit about the Revision Group?
I sure can, and I'm happy to be here. And again, every time I hear Steve speak, I get more excited because the alignment that he discusses on the collaboration is exactly what I've been looking for almost 10 years. So I started the company as a sole proprietor in 2011 on a simple premise that small and medium-sized developers needed help on securing LP capital. I thought LP capital was the hardest in the capital stack. And in my experience for 20-some years in real estate, it always seemed like developers, it prevented them from growing, as well as it took a lot of their time. And when I started analyzing it and worked with one of my mentors, Dean Adler, I understood how hard it was to not only get in front of big private equity groups, but more importantly, the skill set to get them excited by putting together a deck and offer memorandum. And I thought that I was unfortunate or fortunate. I became a developer in 2013 for 13 months in North Dakota, and I realized the time and the patience and the effort it took. And I thought, how could people do both? How could they be developers and capital raisers? So that was the premise of the company. We've grown in the last 10 years to, again, do about $750 million worth of equity transactions, focusing on the limited partner investments with family offices, high net worth individuals, and private equity groups as our capital source. About the last 3 years, we always started getting the question, hey, can you guys do debt as well? And we'd rather work with a one-stop shop. And so I had a lot of debt connections through local and national brokerages and some of the agencies, but never somebody that I felt comfortable with. And again, as Stephen mentioned, we met him a year and a half ago. We were super impressed. We actually, one of our partners went out there and met those guys. We had tons of Zoom calls and tons of conversations. We started giving each other mutual referrals, and it worked out well. And I have an expression in my world, in our business, that you you're only pretenders until you go to the bank together. And we went to the bank together a few times, so they became real players. And then I don't know whose idea it was, probably their idea because they're smarter than we are. They said, why don't we do a formal joint venture agreement? And for the last several months, we've been working on it, and I'm thrilled to let the world know that Tauro Capital Advisors and the Revision Group are now formally joined at the hip on some of the deals that we're doing together. And it's been nothing but a pleasure to work with them. We are going to actually be working together in Chicago. I'll be meeting Steve and Scott for the first time September 13th. We have a show together to do, one of the first live remote shows in Chicago in real estate. And it's just going to be a real exciting time for us. So we're very excited.
Thank you for that, Michael. Appreciate that. So Steve and I will start with a couple of questions for you.
Okay.
First question. I hear a lot of people say that debt is a commodity. Can you tell me why you believe that is wildly untrue?
Sure, absolutely. And I think mostly people think of it as a commodity because they hear, especially for homes, all these commercials about low interest rates and why they should go to this company or that company, and you can walk into a bank and talk to a loan officer. And so it's very easy to think of it that way, where people sometimes are not cognizant of the fact that interest rate is not the most important factor. It is an important factor, and sometimes I guess it could be the most important factor. But there are other parts of loans called covenants that can be very detrimental to borrowers, or in today's world, they call them sponsors. So sponsors need to really take a loan in its totality. But more importantly, that loan or debt instrument needs to be shaped based on what the client is trying to accomplish. So we always start, Eric, with the end game in mind. And the end game really is the end game of when that debt comes due or is available to be paid off. And that is one thing that a lot of clients don't think about, is that prepayment penalty. So we look at the totality. For example, there could be a covenant in a loan that says they can mark to market rents. And what that means is, even though the sponsor is paying their loan without a problem, never missed a payment, their tenants are paying them, no problem, never missed a payment, the bank has the ability to come in and mark to market, meaning what is the prevailing rate in the market? And if it's lower than what your tenants are paying with, and again, they're paying fine and you're paying the bank, they can come back and then reevaluate what the value of the property is based on that mark to market. And what that means is they have the ability to demand, and can do it because of the covenant, to rebalance the loan. And what that means is, when they say rebalance, let's say you owe them 10 million, but the property is worth 8 million, they can make you put $2 million more down, even though everything is perfect. And unfortunately, I experienced that many years ago in Mesa, Arizona, before I ever got into this side of the business. And all of a sudden, fortunately, it was a smaller loan, but all of a sudden they said you have to pay down $600,000. And so that's a covenant. The other covenant can be, on vacancy. Let's say if you're a multi-tenant retail or multi-tenant office or multi-tenant industrial, the lender could have the ability, because of a covenant in the loan, to be able to tell you yes or no on a particular tenant, because that's what the right they've given. So those are just two examples of why loans are not a commodity, because a commodity is like a stock, right? You just go buy it. There's very little that you need to know other than the price. In a loan, there are many covenants that can affect what a sponsor wants to do. And one last thought is the prepayment penalty. What a lot of people don't realize is that federally chartered credit unions are by law unable to charge a prepayment penalty. And they are very competitive in today's loan market. So the one thing that people do kind of get a little upset with, or maybe it's uncomfortable, is it is recourse 99% of the time, versus maybe a non-recourse, let's say a CMBS loan. But then that prepayment penalty in a CMBS loan is either going to be yield maintenance or defeasance, which is very costly. So again, we start at the exit strategy and work our way from there.
That's wonderful. That's wonderful. I've never heard it described that way, and it's very interesting.
Hey, Eric, do you mind
Sure.
if I add something? I know it's not my turn yet. You're going to ask me a few questions, but interesting enough, just as a real live example of what Stephen talked about, Eric and I at the Revision Group had one of our strong clients get a very large, what we call stretch debt loan for a deal in Cleveland, in a suburb of Cleveland, Ohio. And because we didn't have a guy like Stephen kind of supervising that, we just kind of and we set him up. We thought we did a great job, and we probably did a good job. Unfortunately for our client, because they didn't read all the fine print, because certain vacancy has now gone down. I'm sorry, occupancy's gone down and vacancy's gone up. They've created a cash sweep where my clients can't collect their rent until they satisfy that. And they were very unhappy, and maybe rightfully so. Obviously, they're responsible. The buck stops with them. But Eric and I wish we would have had a group like Tauro at the time, because they might have pointed that out or maybe even suggested a different group. So it's a real live example of why someone like Tauro Capital Advisors is so important on advising on the debt security.
And let me just add, onto that, and the cash flow sweep, and that's called a lockbox. And
Yep.
there can be variations of a lockbox, which could be a hard lockbox, which is what you described, Michael, or a soft lockbox. And you're right; those are the things we look at. And let's face it, on a CMBS loan or other loans, there will be a lockbox, but negotiating those triggers as to when that lockbox comes into effect are extremely important.
Yep.
Yes, and that's the value that you add to this joint venture, which is fantastic. So, can you, Stephen, can you talk a little bit about the current debt markets, multifamily, industrial, other commercial assets, office, retail, maybe medical, and then a little bit on the development side as opposed to the value add side?
Sure. Generally speaking, debt is very cheap. I haven't looked at it today, but last week, I believe the 10-year Treasury hovered about 1.3%. It's been between 1.2 and 1.3, which is the general benchmark for which loans are cast. Not always, but that's generally what everyone looks at. So generally speaking, debt is very cheap. There's a lot of money back in the market. When COVID first hit, the markets didn't necessarily dry up. What happened was a lot of those business development officers were so involved with PPP because the banks were making a lot of money servicing that for the government that it just took a lot of time. But it is robust. There is a lot of money. It is very cheap. In multifamily, for example, you're probably in the low to mid 3% range. And most other product types, probably the high 3s to mid 4s. There's a caveat. There's very low or little liquidity right now for hospitality, although there is some recapitalization depending on the history, both prior to COVID and then through COVID. And then since we're still kind of in COVID, but we're kind of in that, back end stage. And so what's happened there? Office is really interesting, is that people are still trying to figure out what's going to happen with the office. Is it going to, survive? Personally, I tend to think it will. I think everyone, had a work from home, obviously, and now most people, I think, are fed up, being home all day with nowhere to go. It's put a lot of stress on family relationships, spousal relationships, but more importantly, that socialization of working with somebody and be able to collaborate like we're talking about. You can only do so much on Zoom or Teams like we're doing. You really need to be able to get up and say, hey, Paula, what do you think of this? Or Tommy, what do you think of that? So, but office is, still a little reluctant. Everything else is really, there's money out there. Multifamily, single tenant net leased, and industrial, I would say, are the three most active asset classes in commercial real estate. And even in industrial in cities like Phoenix or Salt Lake City or some of the, harbor places in the East Coast, I mean, lenders are even willing to do it on spec, meaning there is no tenant identified, but the market is so hot that they will, they know that it's going to get occupied. So overall, the debt markets are very robust. Hospitality and office, probably, I wouldn't call them the redheaded stepchilds, but it's very difficult. And then retail, obviously, depending on what the situation might be, would be that third asset class that lenders are hesitant. If you own retail, it's very important to make sure your books and records are up to date. So you would probably want to make sure you have good records for 2019, beginning of 2020. In 2020, and this goes for office as well, what happened in 2020? did you give rent relief to tenants? And if you did, that's fine. But then what happened now? The other thing to be mindful of if someone's in the market for debt is if they went to their lender and asked for a forbearance, best thing to do is write a paragraph of why you need the forbearance, what your game plan was, and how you've come out of that forbearance, because the other lenders are going to look at that.
That's wonderful. Sort of a follow-up question. Are you seeing more debt in the bridge space? Are you seeing it more in the larger lenders, the JP Morgans, the Citibanks of the world, or CMBS stuff? Where are you seeing most of, from Tauro playing, where are you seeing most of that debt coming from?
I would say in your more traditional lenders, it's actually always been there, and it's grown. I mean, like I say, some pulled back. CMBS was, not a player for a period of time. They've come back, and I think roaring, and they're out there with a lot of money. Oddly enough, there was a lot of bridge lenders that kind of went out because they got capital calls. So if someone's not familiar with bridge lending, typically, not always, but typically it's not their money. So they have investors who've invested and they provide a certain return to their investors. Well, those investors got skittish and they did calls. They wanted their money back. So a lot of bridge lenders actually went out or ceased lending. But we've seen, I would say in the last 3 to 4 months, a large number of them resurfacing, reshaped, or some new ones coming on the market.
And to talk a little bit about those bridge lenders, have you seen sort of a shrinking of the market, getting rid of those who were just had a great ability to raise money but really didn't know what they were doing, and now the remaining bridge lenders are really a core set of folks who know how to do both sides of the game?
Yeah, that's a good point, Eric. And realistically, and Michael, you know this as well, in the real estate world, just generally, when bad times happen, it does thin the herd, and the cream typically rises to the top. And then when it starts becoming more robust, then you see, especially in real estate, all of a sudden everyone's getting their real estate license, or everyone's trying to broker a loan, or you have these bridge lenders, they all of a sudden have a family office and they have some money and they want to get it out there. So that's exactly what happened in all aspects of real estate.
Yeah, being a licensed real estate broker in the state of Florida, I can attest to all the folks who should not have a license down here. There are a lot of them. Well, Stephen, I appreciate that. All that information was extremely useful. Now we'll pivot over to the LP equity side, and we do, as Michael chimed in, we would love for you, if you want to chime in, if you have anything where Michael brings up some points and you want to ask any questions, the floor is certainly open for that. So, Michael, your first question I have for you, I hear people talking about LP equity all the time, limited partner equity, for those who might be listening to this and not understanding the acronym LP. Why is it so difficult to attain LP equity?
That's a great question. I think probably the best answer I can give you is when you're a limited partner, you take the risk of upside and downside. Okay. I'm an optimist, and the reason I like to raise the money is I like the upside, but you have a downside when you're a limited partner. When Stephen and his group secures debt, they have security, they have collateral. So if the thing goes bad, the bank or the debt fund or the bridge lender can go ahead and secure the asset. The LP has none of that. So they have no security or collateral. All they have is the faith that the sponsor is going to do a good job. The sponsor's projections are going to be what they projected and presented, and hopefully there's a stronger upside. Again, just for all the people that don't quite understand it, the GP is the general partner who's generally running the deal. The LP is limited partner, or sometimes called passive. They don't really have any say in anything. And that's important. Now, remember, the debt where Steve was talking about is cheap, very inexpensive now at 3% and 4%. The LP is generally going to charge a lot more, maybe 8 to 10% for sure, and hopefully even a lot higher than that on a lot of deals. So it's what we call a risk-adjusted return. The returns are much higher than what a bank gets, but the risks are much higher because they don't have any collateral. And if the thing goes bad, the bank gets their money first. So generally, an LP can lose all their money.
Fair enough. That's appreciate that explanation. Can you talk a little bit off the back of that? I know there's a tranche in between LP and the senior space, preferred equity.
Yep.
Can you talk a little bit about preferred equity and what might be the benefits and/or the downfalls of preferred equity?
Sure. So preferred equity is a hybrid, really, between LP equity and a loan. So preferred equity will take less of an upside. They do not share in the upside as a developer. So let's say you're a developer and you are underwriting, you're projecting a 20% IRR in a 5-year period, which would be a 2-point equity multiple. You double your money in 5 years. That's pretty good. Most people listening to this would like to double their money in 5 years. If there was a guarantee from, 100% guarantee, everybody would sign up for it. There are no 100% guarantees on that. The pref gives more of a guarantee where they don't look for a 20%. They look for anywhere between a 8 to 13%. And they still are subordinate to the debt. So everybody has to understand that. They're not in the first position like Stephen's debt is, but they're in a second position where the LP and the GP are subordinate to them, and there's a guaranteed generally payout. Now, generally, you get pref, most of the time I see it, on deals that are already cash flowing. Now, you can do it also on ground up as well, but when they're cash flowing, the sponsor will give a guaranteed, let's say 8%. Now, remember, I don't want to get you confused. Preferred return. That's different than pref equity. They have the same acronym, but preferred return meaning we're going to guarantee giving you 8% a year. Pref equity meaning is that we're going to try to, or almost guaranteeing you, giving you a 12%, 13% IRR or return. And once there's a capitalization event, Eric and Stephen, on either a sale or a refi, the pref equity is eliminated. I don't mean that in a negative way. They cash out. As Stephen said earlier in his discussions, and something I learned early in my business career, the exit's very important. So the pref equity person wants to know my exit. How long and what do I get? And that's pretty well known in a pref equity investment. I'm going to be out in 4 years. I'm going to get 12%. The LP, again, going back to that, they don't really have that kind of knowledge of what their return is going to be. They're hoping it's more than 12. They're hoping it's 25. And we got to be careful as capital advisors to set their expectation, show them the risk, show them the returns. And again, I'll skip to another question you might want to be asking me. How do we do that in the best way? We vet out the sponsor. So before we present a deal to an LP investor or a pref investor, we make sure that sponsor has done many deals. That sponsor is what we call first in class, or best in class, and that sponsor has tremendous reporting ability, tremendous history. And again, then the final part is that sponsor knew how to buy, whether it be a value add multifamily or office building or industrial deal, or he's bought the land at a good basis. So, we really put a lot of emphasis on basis. Once we do our homework, then we can present what we think is a great risk-adjusted return to either a pref investor or an LP. Last thing, and I know I'm going on a little tangent, but you asked me the question, could you tell me the advantages and disadvantages? So for the sponsor, which you didn't ask, I don't think that question, maybe you did. For the sponsor, if you get pref equity and you believe in your heart to heart and your underwriting that you're going to get a 25% return in 3 years, then it makes sense to get pref equity, because now you're giving away 13 and you're getting the extra delta of the 12. So it gives a pref equity and any LP people that are with you or yourself a good sense of security that you're really confident you can do it. When a sponsor is not confident they can get these high returns, generally that doesn't exude confidence for the pref equity groups as well. So that's a good advantage if you're confident you're going to have a great return, to try to bring in some pref equity to actually enhance your personal return.
So going
Eric,
back
can I
yes,
make
Steve,
a quick comment? And thanks, Michael. That was great. And you made me think of something when you said, talking about best in class sponsors. Even with the debt in today's market, sponsorship is extremely important in their evaluation or underwriting, especially if we're talking about new construction. How many times have they, gone full circle, meaning have they constructed and then whatever their exit strategy is, sold it? If it's two new partners, that it can be looked at negatively as well, because have they interacted before? So in today's world, and I'm glad you brought it up, sponsorship, their history, their capability, and what they've accomplished is extremely important.
And Eric, one of the reasons we really valued our new partnership with Tauro is they put the same emphasis on the sponsorship. There's many ways to vet out a sponsor. I always say, and I don't want to sound bravado, that we never met an equity group that spends as much time and as much detail vetting out the sponsor. I don't have a lot of skills, Eric, as you know. I have a hard time even reading and underwrite, but I do know people, and that's been one of my good skills, is understanding the sponsor's capabilities and the probability of them succeeding.
don't sell yourself too short, Mike. You can do a lot more than you believe. So pivoting back quickly, and just give me maybe 30 seconds or a minute on preferred equity. You said they, somewhere between 11 and 13%, give or take. Maybe it goes a little higher on the ground up side. How do they get? How does the sponsor cover that number? Is there a breakdown in what they pay up front and on the back side? How does that work?
The answer is you got it. You're spot on. Generally, it's all negotiable, but generally there's anywhere between a 6 to 8% preferred return. That means the first monies coming out after they pay the interest to the debt goes to that investor. They get a 6 to 8% return. Now, if it's ground up and there's no cash being generated for 3 years, that's accrued. It's generally not compounded. The investor wants it compounded, but it's generally accrued. So the sponsor will owe, on a ground up deal, owe that pref investor 6 to 8% per year. Once the cash is generated, they true up on that 6 to 8% ongoing. And then on a capitalization event, which again could be defined as a refinance or a sale, they true them up to whatever was negotiated, and they have to true them up to, let's say, a 12.5%. So they get that 12.5%, there's an exit, and they're out. And then generally the LPs and the GP are still in the deal, or maybe they sold out too. And no matter how much the profit is, again, I'll repeat that, if the profit is 40%, you, the sponsor, are only giving the pref investor 12.5. That's what you negotiated. Then you and the rest of the LPs, or if you're the only LP, get to enjoy 40% on your money, and an extra, in that example, 28% on the pref investors' money. Did I confuse you? Did you understand that?
No, that's wonderful, and you just did the math really well. So you know more than you know.
Got it.
So I'm going to pose a final question to start with. Michael, I want you to answer this, and then Stephen, I want you to touch in. What differentiates the LP bucket from the revision group in Tauro, which again leads to our synergy, is the revision group focuses heavily on family offices and what we call quasi-institutions or real estate funds, whereas the Tauro Capital Advisors focuses more heavily on the institutional side, on the LP side. So, Michael, I'd like you to talk a minute or two about why we believe the family office and the quasi-institutional money is quote unquote nicer money, friendlier capital. And then Stephen, maybe you could talk a couple minutes about the institutional side and what they bring to the LP side as well.
That's a great question. I think they both have a purpose in capital raising. I've just found out, maybe because I'm a simple guy, that, and again, working with some of the larger institutions, they tend not to be, you use the word friendly, they tend to be just a little bit more constrictive and tougher on the smaller and medium-sized developers. And again, as I mentioned in my earlier summary, the small and medium-sized developers don't really understand sometimes what the larger institutions want. They can't conform to the reporting. They can't even conform to the initial offer memorandum. So Eric, you and I have, we've created a niche where family offices, some high net worth individuals are a little bit more lenient, and they'll also look more at emerging sponsors. And that's been kind of our niche where, there's an expression, some of these institutions loan to own. We don't want to bring those people in. We don't want our developers to lose their property because they're late, or their debt service coverage ratio is not quite what they negotiated. So we need to really create a nice alignment. And that's why we've kind of, steered towards the family offices. That $2 to $20 million LP check is kind of perfect in the niche that we're working. Plus, from a competitive advantage, and again, we're working with Steve now, we're not competing with them, but if Steve was a competitor and all he had was the top 10 private equity groups, they can't do deals with 2 or 4 or 8 or $10 million in a 3-year exit. They might have a minimum of $50 million on a 7-year hold because a lot of them are, long-term private equity funds. So that would be kind of the difference, I think, between our focus on the equity.
Stephen, your thoughts?
Yeah, no, I agree 100% with Michael. And what's interesting is with institutions, the people that you're dealing with, it's really OPM, right? Other people's money. It's not their money. Whereas with family offices, it is their money. So to some extent, the family offices, correct me if I'm wrong, may do a deeper dive because it's truly a partnership. With the institutional, they do kind of beat them up because they're the big fish, right, in the little pond. And also, like I say, it's not their money, and it is, like Michael said, they're going to look at something probably 20 million, but really, you're right, Michael, they really want to be 50 million and above, or they're really not going to look at it. So, in essence, it's great for big developments. I mean, if you're a big development, you probably want an institution because you need that sophistication that maybe a family office may not have. Doesn't mean they don't, because there's some very sophisticated family offices. But generally speaking, they're a tougher nut to crack, and maybe not as responsive as you'd like them to be.
Well, there's 2 more notes on that. I'm going to piggyback on what Steve said. The positive also part about the bigger institutions is they might, as he said, sophistication, and they might be able to bring leverage on better debt and on even land acquisition and on political connections. So there are some advantages. The other disadvantage, which Steve didn't mention, which I found, is because it is other people's money, the majority of people that are handling the decision making are younger, call them Ivy League groups of people that really, they're justifying their job. And all day long, they're just looking, they're not looking at the developer as a developer, as a person. They're looking at him as a statistic or number. And to me, that's a disadvantage. And the majority of analysts or acquisition guys or investment advisors that are working for these institutions, they haven't developed even a birdhouse, okay? So they don't really know what's going on. They don't know what's in, how hard it is. I find some of the high net worth individuals and even family offices, because they made their money as a businessman or woman, they can empathize more than these, and I don't want to cut down the Ivy League groups, but the younger, more 24 to 35 to 40-year-old analysts, they haven't been out in the world yet, starting their own business. And I think they lack empathy. And that's one of the reasons we kind of gravitate towards more of the family office and high net worth individual.
Couldn't agree more.
Very fair point. And I had trouble building a birdhouse myself, so maybe I fit in there. You guys have been extremely informative as to the debt and the equity side. I want to get a little granular here. So I have a question that I want to pose to both of you. Tell me how each respective company, Tauro Capital Advisors and the Revision Group, separate yourselves or set yourselves apart from other, or differentiate yourself from other advisors within our field. Stephen, why don't you lead us off on that?
Yeah, sure. I think it's really simple. It's our culture, which Scott and I were very fortunate enough to be able to establish, right in the beginning, and then we can reinforce that. And it's the people, people that we hire. We don't hire just anybody, and those people have to embody the culture. We have 13 guiding principles that we talk about when we hire people, and they actually, as part of their new hire packet, actually have to sign those guiding principles that they believe and will adhere to them. So I think that then manifests in the fact that we have no silos. We're highly collaborative. We right now have 30 people in our company. As you guys know, we just opened up Orange County, Sacramento, and we'll be opening up Phoenix in the next probably 30 days. And that's the only concern we have on this expansion is maintaining that culture, because the results for our clients are tremendous based on all that. I always tell people, Michael Friedman, if he was with Tauro, I'd say, he's your one point of contact, but in the background, Mr. or Miss Sponsor, you have 29 other people working on your deal. Because I always tell people we're like the Three Musketeers, all for one and one for all. And that's how we differentiate ourselves as opposed to other companies where there are silos, where, those advisors or brokers or whatever they call themselves may have conversations, but they really don't know what each other's working on, meaning there is a void in information that can be shared. And that's where I think Tauro's major difference is that culture, that collaboration, and as I mentioned, the people that are part of our team.
Thank you, Stephen. Now, Michael, before I go to you, Stephen, just one quick question. Having spent, I believe it's 22 years at Marcus and Millichap, did that help you? Did that help you to see those silos and not want to bring that to your baby, being Tauro Capital Advisors?
Yeah, a little bit of both. I mean, there definitely are silos, especially on the real estate side. I mean, and this is not unique to Marcus Millichap, it's most real estate companies. When you got up and moved from your desk, you would turn your paper over or lock, because nobody wanted anybody to see anything. On the debt side and the equity side is much different. But, it did, give me an idea of the silos. And also at M&M, to their credit, there was collaboration, not to the extent that we're doing it, but I could see it on the periphery. And so that's why I said initially when Scott and I created the company, we looked at best practices. Some we expanded, some we, just threw out, but it did give me an appreciation for exactly that.
Wonderful. I appreciate that. Michael, can you touch on the revision group for us for a few minutes?
Yeah, well, I'm going to piggyback one thing on what you asked, Stephen. I think one of the things that I brought to the revision group, and now I think our culture is similar, is again, I've been in real estate since the 90s, so I've seen a lot. I've gone through a lot of ups and downs, and I've been fortunate because of the way I network to have been involved with, several $1 billion, probably close to 10 now. I was trying to calculate of real estate opportunities that I was either involved with or had good friends and business associates that did it. So I saw what works and I saw what doesn't work. And the thing that, I mentioned empathy before, because I saw developers lose everything and because I went through a few real estate cycles, I think I can really understand what the sponsor goes through and what they want. And in the last 10 years, I understand what they want, which is not to worry about capital raising for their growth. So, we focus on growth of the sponsor. If a sponsor just wants to do one deal, they're probably not a great client for us. But if they want, to grow, and they got to grow out of their friends and family and country club buddies, they need, we believe, a group like ourselves. Now, as you know, Eric, you've heard it 100 times because we're partners. The other differentiator we have, I would say two, is one is we spend much more time vetting out the sponsor. Our bread and butter and our kind of residual to keep our company growing is our relationship with the capital markets. We can't make a mistake. So we can't introduce a sponsor to a capital partner and that sponsor be either bad or unscrupulous or something that causes an issue. That's our residual programmatic relationships with our capital. So we really spend a lot of time. And then I'm going to go back to an old school concept, maybe me being in the Midwest, is that we just work harder than most of our competitors. We work like all real estate people, and Stephen and you, Eric, are both real estate both been real estate brokers in your career, we work 7 days a week. I happen to, and I think our culture of our group that works with us, we have 9 of us, we work harder than most of our competitors. We are responsive. I would say I've never met a group that's as responsive as us. And in my 10 years of running the revision group, I've never had one critique or criticism, hey, your team or you didn't call me back. And I know it's simple to talk about, but our capital groups and our sponsors appreciate that responsiveness. And that really, I am not, look, I know a lot of groups that do what I do, and I know a lot of sponsors, and I know a lot of capital groups. All three, I haven't found a group that's really as responsive as we are. And we hang our hat on that, and we're proud of that. And I think that's really what's made our company grow from, one person doing, a few $1 million to 8 people, $750 million 10 years later.
That's wonderful, Mike. I appreciate that. And I'm sure Stephen does as well. And it kind of leads into my final question, which, it's clear to see, and it's clear that we've been working for the better part of this year and a half to create this cohesion and this synergy between the two firms. I'd like to hear from the two principals. How do you see the two groups together creating, I'm using the simple term, waves in the debt and the equity market, in the full capital stack market? Michael, start us off.
Well, I think it really is pretty simple. Again, we talked about it during this whole podcast. We're aligned culturally. We're aligned in where we want to go. That we might have different growth ambitions, and look, they have several offices. We have a few offices. They have 30 people. We have 9. We're not competing with the growth of the people. What we are collaborating, and I liked his word before that he gave Marcus Millichaps a little bit of credit. We're tremendously a collaborative team right now. And I think the fact that we can be a one-stop shop to any and all of our clients. Look, they call, their name of their company is Tauro Capital Advisors. Every call I have, I say Revision Group or Capital Advisors. That word advisor is a pretty important word. We're both advisors. We're both trying to show and lend our experience, our collective 90 years experience between Scott, Steve, maybe 100 years, throwing you in there, Eric, 100 years of experience. We're trying to lend that and create the best possible scenario, for our client. Look, a long time ago, Cleveland-based company called Progressive Life Insurance. You guys remember, you guys know them. I think, that girl who's now their face, what's her name again? I forget, in the marketing campaign. But their old marketing campaign about 15 years ago, and I know some of the executives, was Progressive gives the client 5 different alternatives. You might pick ours, you might pick something else, but we're going to give you the 5. I kind of think that's what we're doing with Tauro. With their group and our group, we're giving our clients some alternatives, some optionality. It might not be the best, our combined or them by themselves or us by themselves, but we're presenting it that way. And I think that's going to create tremendous goodwill in the marketplace and tremendous growth.
Wonderful. It's Flo, by the way.
Flo, thank you.
Yeah, she's a wonderful lady.
Yeah, thank you.
Stephen, maybe you can touch on that for a minute or so.
Sure. I mean, there's very little I can add to what Michael said. I think it's the fact that we're best in class in debt, you're best in class in equity, and we bring that one-stop shop, as you mentioned, Michael. I do also think the fact that you're East Coast and we're West Coast allows us to, tap into things that we couldn't do. I mean, I grew up in the East and I have friends in the East, but, having boots on the ground in the East is tremendous. And I'm sure you feel the same way, is that, you guys come out but having boots on the ground here. So this is what's really great. Again, we're not siloed. You're not siloed. We're sharing that information. We're collaborative. And again, I truly believe, as I know you guys do, that's why we're partners, is that we're delivering the best result for the client.
Gentlemen, thank you very much. We've been at this now for about 40 minutes, which is fantastic. Your knowledge is second to none. Our sponsors who are about to embark on this JV journey with will be extremely appreciative of all this. I want to thank you very much for letting me host this, and I look forward to the next time we can put a podcast together with a specific target in mind.
Thank you, Eric. And if you want to get out of the real estate business, you have a future in this moderating business. You're pretty good
Yeah,
at
no
it.
matter,
Maybe it'll be both sides. Maybe we'll make this a weekly or at least a monthly show.
There you go.
that'd be great.
Fantastic. Thanks,
Thank you
Steve.
both.
Thanks.
Have a
Thanks,
great day.
guys. All right,
Bye.
take care.